Hi, you're here with Zoe Arthurs, and we're just going to first of all introduce a two-part tutorial on this one. So we're going to start off with costs relevant to business, and then we're going to move on to sources of finance. So I just want to dive straight in because there's a huge amount to cover within this 10-minute tutorial. So the first thing to make you aware of are the 4 different types of costs. So the first thing you need to be aware of is the fact that when you have this fantastic business idea that's going to make you a huge amount of profit or make a huge difference in the world, you're going to have to inject some sort of capital funds to get your business to the point where it's operational. So this will be in terms of your startup costs. Now, as I say, these costs are involved in the very setting up of your business. So they're paid before your business can even operate, produce a product, provide a service. And it's important to recognise exactly how much they're likely to be before you start your business, because quite often people skip this stage. They only look for the running costs, they'll look for the day-to-day costs, and actually it's the startup costs which quite often require the most amount of money. So they could be things like your fixtures and fittings, your IT infrastructure, it could be the staff that you need, or any services that you have to have provided in order to get you to the point where you can actually make some money. So the second one is your running costs. Now, hopefully you've got through the startup phase, you've got this fantastic product or service, and these are your costs that are paid on a day-to-day basis. So they're your running costs. So if you do not pay these, basically your business will not operate. So hopefully at this stage, you've identified how much of a product you need to either make or sell or services you need to provide, and you're able to identify what your daily costs are likely to be, so that you're able to make sure that you're actually making enough money to remain operational and hopefully lead to profitability. Now, the third one is variable costs, and we're going to talk about this one at length. And this is almost always linked to production. Now, these costs will change and they will depend on how much of your product is made. So just to give you a very crude example, and I will show you an infographic on the next couple of slides, but if you're making 10 items, let's say your product cost to make is £100, but if you make 100 items, then for example, it's going to be £500. Now, you'll also hear that I will use the term economies of scale. Now, economies of scale basically means the more product you buy, the lower the unit cost, because you're obviously buying it in bulk. So what you should find is the more of your product you're making, the lower the unit price, or the unit cost, sorry, is to make it for you, which will mean that you're then able to gain a greater profit margin because it's costing you less to make it, but you're still selling it at the agreed price. So then the final one you need to be aware of is fixed costs. Now, these are costs that do not change, regardless of the amount of product that you actually make. They're almost always displayed as a horizontal line on your break-even chart, because they can be attributed to things like utility bills, perhaps, rent or council tax. So regardless of how much you've actually made in your business that month or that week, you still have to pay that same fixed cost in order to keep your business operational. So here's just a really nice infographic for you. Feel free to take screenshots or pause the video at this point, because it will help you with revision notes if you're following along from a business qualification. So here's the infographic I was just referring to. So this is your variable costs, and it basically links to the amount of products. So it's almost always attributed to production. So if you've got one product down here, you will see an increase, but your variable costs will increase, but actually your unit price will decrease. And then here's a really nice infographic just to reiterate what I said about fixed costs. So let's say that the £300 here is for your rent on your premises. So every month, regardless of how many products you're producing or services you're providing, actually you're still having to pay that same £300 cost on your premises rent. So a really good example on that one, as I say, is a utility bill, or as I say, rent or council tax. So here's a really short activity I just want you to consider. I want you to think about whether each is a fixed or variable cost, and just to list under 2 headings, startup and running costs. Now, if you do this activity, you may just find it useful to put an F if you think the cost is fixed, or a V if you think it's variable. So pause the video and I'll see you back in a second. So here's a couple of answers for you. In terms of the startup costs, we've got things like you may need machinery or equipment, fixtures and fittings, furniture, computers, or you may just need a simple premises. And on the running costs on the right hand side, and I'm sorry if this is a little bit pale, but you may need stock, rent rates, raw materials, electricity and gas charges, for example, insurance, materials, wages and salaries, telephone call charges, or perhaps you've just got motor expenses that you need to account for. So remember that your startup costs are needed before your business becomes operational, and then anything your business needs to run on a day-to-day basis is known as your running costs. So I've got a couple of sentences here. I just want you to fill in the gaps using the words either costs or revenue. So pause the video and then we'll come back and I will show you where the answers are. So if you had number one, it's costs and revenue. So the bigger the business size and the higher the costs and the revenue. The more a business sells, the more, you've got it, revenue it receives. The more employees a business has, the higher the costs, absolutely. And the more premises a business has, the higher the costs. Good. Okay, so that's just introducing you to revenue and costs. But what I want you to think about and just write a short definition of is what you actually think the word revenue means. So pause the video here, write your definition, and then check against mine. So my textbook definition, if you like, is the total value in pounds, as obviously we are in the UK, of sales made within a trading period. So what's important is it's linked to sales. So the amount of items or product services that you have sold, that is your revenue, okay? So it's not linked to your profit. It's not before expenses. It's only the amount of money you have made through selling your product. So here's a really quick formula. So when you're looking at your own businesses, I just want you to think about how revenue is calculated. So it's your price, so your selling price, times the number of products you have sold. Now remember, revenue is not profit. This is just money that you have made through sales. So if I'm saying that revenue isn't profit, well, what is profit? So again, pause the video and then write a definition and then check your answer against mine. So this is the amount of money made after all costs have been paid. So after you've taken your sales revenue figure, you've deducted all your business expenses, that's what you have left. So that's your profit, okay? And it's really important that you identify the difference between revenue and profit because you're going to need to record the accurate figures on your profit and loss and balance sheets. So just to make you aware, this is the profit or loss formula. So this is to identify how well your business is performing. So it's revenue minus costs will equal your profit or your loss. So on the example I've provided you here, if we had £100 worth of revenue and our costs are £70, obviously, go back, then it's going to cost you, you're going to have £30 worth in profits. So if you remember from the previous slide, and I've just put you a recap there, in order to calculate your revenue, it's your price, your selling price of your item, your product or service, multiplied by the amounts of, that you've sold. So pause the video again. I just want you to think about what break even is, because it's really important you identify what break even is within your business so that you're able to move forward and identify how many products you've got to make. So break even is the equality of revenue and cost. So it's where the business is neither making a profit or a loss. So it's at the point where the two lines cross on the break even chart, and feel free to watch my break even tutorial, which will guide you through how to make a break even chart. So if your sales are £10 and your costs are £10, therefore actually you are breaking even. It's at the point where your business is sat at zero. So here's a secondary task for you. I just want you to think about actually revenue is more than costs. Obviously you're making a profit. Revenue is less than your costs. Obviously you're making a loss, but your revenue is equal to your costs. You're making a break even. So it's just really important that you actually identify those 3 points in your business. So what I want you to do is just use simple figures and make up 2 examples for each of the situations above. So just write out some very simple formulas so that you're able to get to grips with actually when your business is making a profit, a loss, or it's at the break-even point. Pause the video and I'll see you in my next tutorial. Thanks for watching. Bye.